Welcome back, traders. Today we're going over Monday's price action in euro and the opportunities it offered. These breakdowns will help you recognize repeating patterns and typical DR characteristics. At the end of the video, I will also show you what possibilities data insights would give you on top of that. So make sure to stick around until the end. Euro FX futures on this week's Monday started with the aftermarket session confirming short, retracing all the way back to the opposite side of the defining range, failing to close above it and then extended toward one standard deviations. Later in the session, it came back to the opposite side of the DR once more and confirmed a DR false session by closing above it on a 5-minute time frame. The overnight DR session then formed and a short confirmation happened almost immediately, which then led to a retracement back to the IDR mid before price extended to the one standard deviation level at the end of the session. This is where it starts to get interesting. Do you notice that the overnight DR session played both sides of the aftermarket session? It took both the highs and the lows. Already here, you can see possibilities that a DR range expansion model is forming, which could lead into a trumpet-like price action behavior throughout the day. But we don't know anything yet since the regular DR session needs to form at first. And this is what includes the next step. The regular DR session has formed, closing as a green DR box. And when measuring all three DR sessions in its sizes, you can clearly see that each DR session box expands its previous session box's size. Already here you have a high probability target for the session, but don't know into which direction yet. Just with the next candle, price confirms into the long direction. You can now tell that price wants to complete a trumpet-like price action behavior most likely. If you're preparing for a session to trade, you should already have gap imbalances, volume imbalances, as well as previous DR session levels easily accessible. That's not something you should do after the confirmation has happened. There are several previous volume imbalances, so try to reduce them to significant ones, like these two open magnetic volume imbalances inside the range. They tend to be magnetic for price as they haven't been rebalanced yet and will be revisited at some point in the future. Then one of my favorite DR basic teachings. Intraday gap imbalances, especially the ones from the aftermarket DR session. Highlight them by any means. Lastly, make previous DR session levels easily accessible to toggle on and off when needed. Again, we have two open magnetic volume imbalances inside the range, these intraday gap imbalances, which all of them except one is from the aftermarket DR session and several previous DR session levels. You can already tell where it's more likely to retrace back into and where possible entries could form. Price extends a little bit further after the long confirmation before it retraces into the defining range and violates a strong barrier at the top of it. With the next 5-minute candle, it fills one of the open magnetic volume imbalances, rejects an aftermarket DR session intraday gap imbalance and closes back above the defining range. This can be your first potential bullet for the session here. The target is obviously the one standard deviation level, but with an entry right here, it would not offer enough R to make it worth risking 1R. This is where you can start to think about a limit order. One more retracement back into the IDR high level would offer potentially 3R. If it doesn't happen, tomorrow is a new day. You ain't gonna catch them all. If you get stopped out on that one, there would be another possible opportunity with multiple confluences like another open magnetic volume imbalance, the IDR mid and previous DR session levels stacked up, which offer an even better risk to reward. With the next candle, price fills you in the trade and makes its move toward two standard deviations for the session. Are you slowly starting to recognize repeating patterns? This has been shown a couple of times now across different assets on my channel. A beautiful trumpet-like price action throughout the day, with both sides of the market being played, and the market gave early signs for that. Let's remove all from the chart and focus on what would have been suggested by historical data from the past 18 years for that exact scenario and see if the overall performance would beat the DR basics. First of all, Monday long confirmations between 10:30 to 11 a.m. have a 79% true rate. If we're filtering only for the true sessions, the first thing to focus on would be the time. 12:15 p.m. marks the median time, where historically 50% of maximum retracements for the session happened. So 10:30 a.m. to 12:15 p.m. would be the time window to look for entries if a long confirmation happens in the first half an hour. By selecting only that time window, we get a clear distribution in the maximum retracement window. Technically 0.2920 would be the first cluster, but since that would include retracements outside the defining range, you can reduce it to the plus 0.09 to minus 0.2 level. That would be the first area to look for potential entries. With a stop loss below the minus 0.2 level, you would cover 83.72% of historical max retracements. A second potential trade can be taken in the minus 0.3 to minus 0.5 area. Under these criteria, price never had its maximum retracement in the minus 0.51 to minus 0.7 area. Therefore, a stop below the minus 0.5 area would cover more than 90% of historical max retracements. Why should you rather wait for a retracement back into the defining range rather than taking a trade outside of it? Even though historical data measures multiple retracements in the positive retracement area of plus 0.29, it also shows something else. Price retraced back into the defining range 81.9% of the time, while it retraced 71.3% of the time into the implied defining range. In this case, 0.29 is outside the defining range, and with this statistical insight, you ideally want to wait for a retracement at least back into the defining range. Lastly, data reveals that 70% of the time, price extended toward one standard deviation and slightly lower to the 1.2 to 1.29 standard deviation level, which marks the extension that's been reached most frequently. For that reason, you might consider targeting it as well based on time and price trading. The first bullet for time and price trading would have been stopped out, while the second bullet would reward you with plus 5R. Please keep in mind that what I show here is strictly for Monday long confirmations between 10:30 to 11 a.m. and a strict entry window up until 12:15 p.m. Every confirmation after has different probabilities. This makes the session a profitable one with plus 4R, and historical data showed its accuracy again. Must be completely random, I guess. This data is being updated daily. If you want to learn how to trade like a professional using many advanced tools, then feel free to visit M7DR.com. That's it for today, and I really hope you gained some new insights to the DR trading strategy. Have a good trading week, and I hope to see you in the next video.
We're gonna take on the world.